The economy is complex. Markets are driven by forces way bigger than the president. Our job is to build resilient portfolios, stay focused on what we can control, and avoid making impulsive decisions based on noisy headlines, all of which are political at the moment. No single election will make or break your financial future, but staying disciplined, diversified, and mindful will put you in the best position to reach your goals, no matter who's in office.
Do you think money takes up more life space than it should? On this show, we discuss with and share stories from artists, authors, entrepreneurs, and advisors about how they mindfully minimize the time and energy spent thinking about money. Join your host, Jonathan Dio, and learn how to put money in its place and get more out of life.
Hey there, welcome back to the Mindful Money Podcast. I'm your host, Jonathan Dio. Today, we are going to get into it. Before the election, I received all kinds of calls and emails about what we would do if Trump was elected the 47th president. And I explained at the time that we do our level best to separate our politics from our portfolios, offered historical examples of it not working, as well as some academic sort of statistical proofs of how trading your portfolio because of headlines or expected headlines is never a good plan. We can't make investment policy out of chaos theory. And for our purposes, if your goals and resources don't change, your plan doesn't change. And if your plan doesn't change, your portfolio doesn't change. We recommend not changing a beautifully allocated, broadly diversified, and regularly rebalanced portfolios just based on expectations or fears or even greed about a particular event in a short period of time. We invest the way we invest because we can't know the future and because we don't know how markets are going to react, even if we did know the future. And that's the thing. You have to get both of those things right. If you're going to predict, you have to know the thing that's going to happen and you have to know how markets are going to react. We can't know either, so we don't predict. This is a no prediction zone. If you want to talk about how we might be able to help you invest this way, please don't hesitate to reach out. Since the election and since sort of the onslaught of executive orders began, the fear has begun to rise and the questions have been building. And today I want to answer some of those questions. But before I begin, I realize this is like, what do they call it, the third wire of investing, I'm not supposed to talk about this, and politics, religion, these kinds of things, we're not supposed to talk. But let me be clear. This is not an endorsement of Trump or his policies or his approach to leadership or who he is as a person. There's plenty to criticize, and I'm right there next to most of you criticizing, most of the listeners of this podcast anyways. And I'm not here to argue for or against him as a person or the president. What I'm here to do is help people keep a steady hand on the wheel when it comes to their portfolios, their investments. One of the biggest mistakes investors can make again and again is letting politics or any short-term headline dictate their financial decisions. The truth is, markets don't move based on whether we personally like a president. They respond to policies, economic fundamentals, and long-term trends that go beyond any one administration. 47's policies during his second term will have both positives and negatives. Some are going to be great for business growth and the markets. Others are going to introduce risks. Our job as investors isn't to cheer or panic. It's to assess the landscape, manage risk, and stay focused on the long-term financial goals that actually matter, our own. So making meaningful changes to your portfolio based on today's headlines or tomorrow's expected headline has been proven time and time again to be a mistake. So as a tool to help you keep that steady hand on the wheel, today I'm going to go over 5 potential negative items and 5 potential positive items. I want to limit the scope of the argument to those areas that matter to our investment portfolios. Again, my point is to help you separate your politics from your portfolio decisions, whichever side of the aisle you happen to be on. So let's start with those 5 potential negatives of 47's economic policies. First, obviously, tariffs. Trade wars. These lead to higher costs for consumers and businesses. So Trump's aggressive trade policies, including tariffs on China and Canada and Mexico, aim to boost domestic production, but also raise costs for U.S. businesses and consumers. We already know his second term will see even steeper tariffs than his first term. Broadly applied, Tariffs are stupid and hurt Americans by raising prices. You may recall the Smoot-Hawley tariffs of 1930 that deepened the Great Depression, and by triggering retaliatory tariffs, which we've already begun to see from Trump's current round of tariffs. So a little bit less bad, a little bit less stupid are targeted tariffs. So targeted tariffs can have a positive secondary effect. They can protect domestic production, they can shield U.S. workers from unfair competition, and they can support other national priorities like climate policy. But they are still inflationary to the extent that tariffs are passed on to consumers and not absorbed by profit margins or currency effects. Tariffs of all kinds lead to higher consumer prices, as tariffs act as kind of a hidden tax that companies pass on to customers. Essential goods such as cars, electronics, and food could become more expensive. They lead to increased costs for U.S. manufacturers who rely on imported materials like steel and semiconductors to produce goods domestically. This could hurt American businesses rather than help them. It can also lead to global economic uncertainty as countries retaliate with their own tariffs, reducing U.S. exports and hurting key industries like agriculture and energy, where we do export. And then finally, there can be disruptions to supply chains, forcing businesses to make costly adjustments to production and distribution strategies. Anytime you increase costs in a system in any way, this will become important in a moment, right? Anytime you increase costs in a system, these costs must be borne by somebody. Some portion of the cost is always borne by the consumer. This is even more so in a trade war. So while protecting American industries is a valid goal, a prolonged trade war could light a fire under inflation, slow global growth, and weaken economic stability. Second, and I apologize if I sound like a broken record here, the ballooning federal debt and rising interest payments are an issue. We've talked about this for months now, and it isn't just Trump policy. It's more of an ongoing problem, this unfunded spending. Trump's first-term tax cuts and stimulus spending contributed to growing federal deficit, and a second term could see both a reduction in tax receipts and high levels of government spending and borrowing, making the impossible scenario of the debt even more impossible. For decades, the national debt has grown. Between 1940 and 2023, the debt to GDP ratio in the U.S. averaged just under 66%. Today, it stands at almost twice that, at 126%. That's our debt is 126% of our national GDP. For many of those years, 1980 to roughly 2022, the actual cost of servicing that debt declined as rates declined. And this papered over the problem of too much debt. But in 2022, the zero interest rate environment came to a screeching halt. The debt service costs threatened to push us into a forever deficit and a spiraling debt service problem. This brings to mind Ernest Hemingway's famous line in The Sun Also Rises. How did you go bankrupt? Two ways, gradually, then suddenly. If the U.S. doesn't do something about the debt deficit, we will eventually run into a wall. So some key concerns about the deficit is federal debt reaching sort of unsustainable levels. I think we're approaching this point, but unsustainable federal debt leads to higher borrowing costs for the government and reduces the government's fiscal flexibility in the face of a future economic downturn. It also leads to rising interest payments on debt, which already exceeds defense spending and could start to crowd out some critical programs like infrastructure, healthcare, and education. Also, it puts pressure on interest rates as increased government borrowing competes with private sector credit needs, making mortgages and business loans even more expensive. And finally, it can create a long-term economic drag as future generations may face either higher taxes or reduced services to manage this growing debt burden. So while tax cuts and spending can stimulate short-term growth, unchecked deficits pose long-term risks that could weigh on our economic stability. Third, there are inflationary pressures that lead to market volatility. So the combination of tariffs and fiscal spending and deregulation could create inflationary pressures, particularly if economic growth remains strong, but supply chains remain constrained. So some key risks in this area include higher inflation reducing purchasing power, making everyday goods and services more expensive for consumers. We could see increased volatility in financial markets as investors react to uncertainty around inflation, interest rates, and economic policies. We could see a potential need for aggressive Federal Reserve action, forcing the central bank to raise rates to counteract inflation, which would slow economic growth. And then there's always this issue of uncertainty for businesses, this fluctuating of input costs and the unknown, the zigs and zags of policy makes planning and investment decisions very difficult as even a small business, but especially as a national or a global business. So while moderate inflation is normal in sort of a growing economy, excessive inflation could erode confidence and can erode economic stability. Fourth, a big one, and we've already seen this in some of the global reactions, geopolitical risks and then the global market uncertainty. So Trump's foreign policy stance has often been unpredictable, to say the least. It creates tensions between the US and China, with Russia and the Middle East. The increased geopolitical risks could have serious economic consequences, and some of these include trade disruption. So as conflicts with our key economic partners like China lead to reduced market access for US businesses. We say to China, we're going to raise tariffs. China says to us, we're going to raise tariffs. We say to China, you can't, sell this product into our economy. China says to us, you can't sell this product into our economy. So we're the consumers of the world for sure. They are the growing consumers of the world. Our businesses want access to the ability to sell goods and services into China. That's one issue. Second issue, energy market instability, particularly if tensions in the Middle East disrupt global oil supplies, which might lead to oil price spikes. Trump is going to try to, drill baby drill to sort of cover that. You have to remember that the stuff that we export is different than the stuff that we import. Not all oil is the same. And then there's this huge potential for military conflicts, which could increase defense spending and create uncertainty in financial markets, not to mention devastation for countries and the people on the ground. And with all of this unknown, you also receive some foreign investment hesitation. Well, people don't want to invest in a place that they don't know what's going to happen. Uncertainty makes the U.S. a riskier place for global businesses to invest. Markets dislike this uncertainty, and continued geopolitical unpredictability could weigh on investor confidence and economic stability. The fifth and final of our negatives is this weakening safety nets and leads to long-term instability. So Trump has continued to push for cuts to social programs such as Social Security, Medicare, and Medicaid, and other government assistance programs, food stamps, etc. While reducing government spending can help manage deficits, weakening the safety net poses real risks for people. So increased financial strain on retirees and low-income Americans, especially as costs for healthcare, housing, and daily living continues to rise. Greater economic volatility as reduced safety nets mean fewer automatic stabilizers during recessions, potentially deepening economic downturns. This puts a whole huge, bigger burden on private savings and employer benefits, forcing individuals and businesses to shoulder more responsibility for retirement and healthcare, which means we end up saving more and spending less. That leads to long-term impact on consumer spending. As millions of Americans have to take care of their own issues, they'll have less disposable income, so they're saving more, they're spending less. That slows economic growth. And we always have to remember that the consumer is 70% plus of the U.S. economy's GDP. So while fiscal responsibility is important, cutting essential programs could create broader economic challenges, particularly for aging populations and lower income communities. The balance between government support and individual responsibility is critical to long-term financial stability. So in summary, the five potential negatives are: tariffs raise prices on consumers, cutting taxes leads to a ballooning national debt and increasing debt service costs. The economy is already doing well. Increasing GDP could easily push us into inflation and more aggressive Fed tightening. There's always this geopolitical risk, including armed conflict. That always reduces economic stability. And then finally, if we cut the safety net programs, it can save money in the short term, but it can hurt people and reduce consumer spending in the long term. And again, that's 70% of GDP. So those are the negatives, and this is where the pushback is going to start coming. I'm going to turn to the five potential positives from 47's economic policies. Again, I'm recognizing that many of the folks in the Mindful Money audience cannot see any positives at all. So I hope you can open your mind and let just a little bit and let some of this stuff in. There are potential positives, especially as we think about our portfolios, which makes people hate portfolios and makes people feel guilty about making money. And I understand that. I hear this every day. But the point, once again, is to reduce our reactivity when it comes to our investments. So the first positive, tax cuts, and I realize we just talked about this as a negative, but tax cuts can lead to business growth as well. So Trump's 2017 Tax Cuts and Jobs Act significantly reduced corporate tax rates, aiming to encourage business investment, job creation, and economic expansion. And that is what happened. So his second term could bring additional tax cuts, particularly, hopefully, targeting middle-class families and small businesses. There are 2 points I want to make here. First, anytime you decrease costs on a company, whether that's from lower priced raw materials, whether that's lower wages or lower taxes, the reduced costs, at least partially, flow to the company's bottom line. This means more profits for the same revenues. This is just simple math. This is addition and subtraction. Higher costs lead to lower earnings. Lower costs lead to higher earnings. And stock prices follow earnings. Taxes are a cost. Tariffs are also a cost. So I referenced this briefly before in the discussion of the negatives, specifically regarding the tariffs. Anytime you increase costs in the system, in any way, those costs must be borne by someone. So according to a National Bureau of Economic Research paper originally written in 2020 but revised in 2023, about 50% of corporate tax incidents falls on consumers. So if you want to look it up, the paper is entitled Corporate Taxes and Retail Prices. It is NBER Working Paper 27058. In other words, we can't have it both ways when we're arguing. If we add costs, be those costs tariffs or corporate taxes, the added costs get passed through in some way to the consumer. To argue against tariffs because they raise consumer prices and for corporate taxes, which also raise consumer prices, is at least partially disingenuous or misinformed. So I'm not saying that tax cuts are needed or even desired. I'm purely saying that tax cuts often have positive short-run benefits: more business investment, more consumer spending, and more foreign investment, better stock market performance. So some potential benefits from reduced taxes could be encouraging businesses to reinvest by allowing companies to retain more of those profits, which potentially increases capital expenditures, hiring, and wage growth. It could boost consumer spending by putting more money in the hands of individuals and families, stimulating demand across multiple economic sectors. It could, and usually does, strengthen stock market performance as corporations use tax savings for dividends and stock buybacks and reinvestment, increasing shareholder value. Again, we're shareholders. And then it can also attract foreign investment by maintaining a globally competitive corporate tax rate, making the U.S. an attractive destination for multinational businesses. However, while tax cuts can drive short-term economic growth, they also contribute to budget deficits, which could lead to a long-term fiscal challenge, those challenges we discussed above. Second, this is the second positive. And again, I understand I'm going to get pushback. I'm just talking in terms of our investments. Deregulation may lead to industry expansion. So borrowing from legacy Republican playbooks, one of Trump's key economic policies has been reducing regulations across industries, especially energy, finance, and manufacturing. By cutting red tape, businesses can operate with much greater efficiency and fewer sort of compliance costs. I often tell a story about a buddy of mine who owns a retail store in California. There's a group that 100 years ago, this is a state of California department that oversees basically cash registers. So 100 years ago, a critical part of the cash register was the ability to weigh the amount of stuff you were buying. In order to keep sellers from putting a thumb on the scale, what they used to do is they used to send somebody out to take a look at them and their process. And that group still exists. And my buddy who owns the retail store pays, $500, $1,000 a year to this state group in California for someone to come out and look at his cash register to make sure he's not, rounding the cents the wrong way, or make sure he's not somehow putting a thumb on the scale. Now, he's been in business for 22 years. No one has ever come and looked at his cash register. Like, he consistently every year pays this fee and no one comes and looks at it. So this is the kind of thing we're talking about. By cutting bureaucratic red tape, business can operate with more efficiency and fewer costs. Now, the benefits to this is When you have lower operating costs for businesses, particularly in industries such as banking, oil and gas, and construction, they face these huge, heavy regulatory burdens. You get these lower operating costs. It leads to higher profitability when you sort of implement these kind of deregulations. You might see faster economic growth. It makes it easier for companies to launch new projects, to expand operations, to participate in mergers and acquisitions, and to innovate without excessive government oversight. Now, this is not an argument, again, I'm just going back to it, it's not an argument against oversight. It's less oversight increases profitability, more oversight increases costs. And it's mathematical, the relationship. So another thing you might see is with deregulation is job creation in key industries, particularly in sectors that benefit from the deregulation. Again, energy, transportation, industrial manufacturing, banking, etc. So one of the costs of doing business is regulation. And so if you reduce regulation, you might have an increased competitiveness for U.S. businesses in the international market. So as there's a reduced regulatory burden, profitability is increased, and that allows firms to compete more effectively in the international markets. So while deregulation can boost business activity, yes, it also raises concerns about things like environmental protections, worker safety, financial stability. These can pose long-term risks. So we have to weigh and find a middle path through the two extremes of this. Third, if you are, as I am, very worried about the environment, then this one isn't going to be seen as a positive, but there is a potential positive in terms of our investments with energy independence and infrastructure growth. So Trump's energy policies have focused on expanding, increasing, drill baby drill, domestic oil, gas, and nuclear production, while rolling back environmental regulations. Again, this isn't me saying I'm pro this. I'm saying that this has positive impacts on, or can have positive short-term impacts on our portfolios. So the second Trump term could see further investment in infrastructure projects to improve roads and bridges and technology networks. And some of the economic benefits from this could include lowering energy costs for consumers and businesses. One of the things that we see zig and zag the most is the cost of energy. That's why there's a sort of CPI and CPI core. It removes some of the costs that are more volatile. So if we reduce energy costs for consumers and businesses, that reduces operational expenses and increases disposable income for people and profitability for businesses. Greater energy security, so decreasing reliance on foreign oil and minimizing exposure to geopolitical energy disruptions can be a huge benefit for both people at the pump and for businesses. So this may mean more high-paying jobs in energy and construction, particularly in fossil fuel industries and infrastructure development. And a modernized infrastructure could improve transportation, broadband access, logistics, strengthening U.S. economic competitiveness. And I think that some of these things, if you take the drill baby drill, take the energy issues out of it, some of these things can be bipartisan. Some of these things, we want to have strong U.S. competitiveness. And so broadband access and infrastructure, logistics, these kinds of things might be something that we see some agreement on. However, and it's really important that to the extent that we're talking about increased energy production and the economic benefits of increased energy production, we also have to recognize that it creates environmental risks. And large infrastructure projects often require significant government spending. And we've already talked about how if we're going to reduce taxes, we can, but we shouldn't probably also at the same time increase our spending. We need to find a path to get us back on sort of fiscal discipline. Fourth, trade policy and sort of this idea of a domestic manufacturing revival. So Trump has prioritized renegotiating trade deals and imposing tariffs to reduce U.S. trade deficit and bring manufacturing jobs back to American soil. So a second term is obviously, we're already seeing it, will further strengthen this focus. And this might lead to more domestic production and job creation, particularly in industries like automotive, steel, and technology, which have historically relied on imports. We might see stronger negotiating leverage with global trade partners. Right now we're in this period of sort of tariff and retaliatory tariff and conversations, and we say we're going to do a thing, and then we understand, that's probably a bad thing, so we change that. So this could lead to a better deal for the U.S. businesses and U.S. employees. It could also just totally disrupt and create long-term trade partner problems. We could have, if it works to move some of the manufacturing jobs back to the US, we might have reduced dependency on foreign supply chains, making our economy more resilient to global shocks, such as pandemics or geopolitical conflicts. And then finally, one of the things that we do hear talked about quite a bit is this increased protection for US farmers and manufacturers. So decades ago, we started handing the baton of manufacturing over to the international markets. By doing that, we've seen currency translation, but we've also seen sort of the gutting of the American middle class. Now, one of the paths to ensuring that everybody competes on a level playing field, domestic producers and foreign producers, is this use of tariffs. And the problem is tariffs can lead to higher costs for consumers and businesses, and prolonged trade wars often create uncertainty that obviously negatively impacts markets and trade. Fifth, Trump frequently emphasized stock market performance as a measure of economic success, and his policies have generally been market friendly. I think we're not going to see much different from that ultimately in this second term. So the policies in place, we've already talked about some of these, encourage corporate earnings growth. So through a combination of tax policies and deregulation and sort of pro-business initiatives, we should see a continuation of corporate earnings growth. He may shoot himself in the foot with all the zigs and zags. So we have to watch carefully. But if the general tendency to reduce regulation and reduce tax on business and sort of promote pro-business initiatives continues, we should see increased corporate earnings. This means we'll have a favorable investment climate. We'll have a tailwind for our portfolios. This reduces uncertainty for businesses, and it promotes capital inflows from investors domestically and investors internationally. Well, we may see some financial support for the markets through both monetary and fiscal policy. Now, this is a potential positive that's sort of wrapped in a potential negative because we've just talked about this. The Fed is going to be on watch for any of these policies to be inflationary. To the extent that the policies can be maintained in a way that are non-inflationary, we will see Powell and the Fed will be kinder to us with monetary policy. The risk that I see, and we talked about it a moment ago, is the fiscal policy, our spending policy. To the extent that we're driving for both tax reductions and more spending, that the only way you can have both of those is to increase debt. And by increasing debt, you'll increase debt service, which drives us closer and closer to the, judgment day. Someday, investors won't want to buy our debt. And if investors don't want to buy our debt, then the cost of that debt will skyrocket. And that's the thing we have to be careful of. Markets are often influenced by tons of factors beyond policy. And while pro-business policies can drive short-term gains, long-term stability depends on broader economic fundamentals. So the 5 potential positives are tax cuts and business growth incentives. This is just math. Lower taxes equals higher earnings, at least initially. Deregulation. Second, deregulation reduces compliance costs. Lower costs means higher earnings. Again, this is just math. Third, energy and infrastructure spending can lead to more high-paying jobs domestically and greater security. Fourth, trade policy, while it seems chaotic, it has led to better trade deals in the past. However, the tariff retaliation cycle is likely to limit the rebirth of domestic manufacturing. There is a trend since COVID of some domestic manufacturing coming back because of supply chain issues, because other people treated the pandemic differently than we did, and things couldn't get built, things couldn't get done, which created problems on the home front. But increasing tariffs and then the response of increasing tariffs against us, that whole cycle probably limits an increase in the rebirth of domestic manufacturing. The fifth thing is actually really interesting to me because this is stock market as metric. So an old coach of mine told me to measure the things that matter to me. And he said that why? Because what gets measured gets done. The stock market matters to Trump. He wanted to go up as proof of his presidential skill. And that incentive matters, at least in the short run. So I can hear people saying, okay, Jonathan, this isn't terribly helpful. You've given us a slew of reasons to buy and a slew of reasons to sell. So I don't want you to misunderstand. These are not reasons to buy or sell. These are all unknowns and unknowables at this point. We invest the way we invest because we admit we don't know. We do not recommend making meaningful changes to portfolios unless and until there are major changes in your life or in your goals. We talked about the order of operations at the top. Know your resources, discover your goals, write your plan, create your portfolio. That's the order. Nowhere in there does it say, consult your crystal ball, develop a better market theory, or stay on top of all today's headlines. Your resources and your goals determine your plan. Your plan determines your portfolio. If your resources and goals don't change, your plan doesn't change. If your plan doesn't change, your portfolio doesn't change. The key is staying focused on what really matters. No one who sits in the Oval Office can have any effect long-term because somebody else is going to sit in the Oval Office next. And the more the prior person changes it, the more the next person will change it back. And maybe it'll be multiple terms and then the party shifts. So no matter who sits in the Oval Office, one thing remains true. The best investment strategy is a disciplined, long-term approach that separates personal politics from financial decision-making. Trump's policies could boost certain sectors while creating headwinds in others. Some investors are going to be tempted to make emotional moves, either out of fear or into excitement. History shows us that these moves usually backfire. Don't make them. The economy is complex. Markets are driven by forces way bigger than the president. Our job is to build resilient portfolios, stay focused on what we can control, and avoid making impulsive decisions based on noisy headlines, all of which are political at the moment. No single election will make or break your financial future, but staying disciplined, diversified, and mindful will put you in the best position to reach your goals, no matter who's in office. Thanks for tuning into the Mindful Money Podcast. I hope this is helpful, and we'll see you again next week.
Thanks for listening. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at mindful.money. Be sure to follow and subscribe wherever you listen to your favorite podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/mindfulmoney. We'll be sure to read those out on future episodes.